Hello, hello. Welcome, everyone. Thank you so much for being here today. It is noon, so we will get started. We are here with a guest speaker. My name is Melanie Schramm, and I am an education program specialist here at the center. This is the Sokolov-Miller Family Financial and Life Skills Center. We are thrilled that you are here today with us. We have our first webinar in our series today, and it is all about taxes. I will be your host for our biweekly financial literacy webinars, and I hope to see you every other Tuesday. So real quick, if you're not familiar with our center, I just want to take a super quick minute to share out who we are and what we do. So at the Sokolov-Miller Family Financial and Life Skills Center, we are really the hub for personal finance resources for the Penn State community. And of course, we have our webinar series, but we offer so many other great services beyond this. So if you have not checked out our website yet, it is worth a visit. Here I have on the screen, there's a QR code that can take you right to our website. It is a great place to find financial education resources and learn so much more about what we offer. One of our biggest services that we provide is our free one-on-one financial coaching. These appointments are available for Penn State students and alumni, and we also offer coaching related to public service loan forgiveness for our faculty and staff members. Students, you can get right on through your Starfish and schedule appointments there. Faculty and staff members, you can reach out to us through email at finlit@psu.edu. We also provide a bunch of group presentations for classes, clubs, student groups, and some of our topics, maybe like credit cards, identity theft, salary negotiation. All of our topics are listed out on our website, and we actually have right around 30. And like I said, everything that we have is completely free to you. We also have partnership with PNC that you have access through them to additional coaching and education sessions. So please feel free to take advantage of those as well. Session today. But yeah, so let's start with taxes. I'm really excited to introduce out our guest speaker. We at the center have a strong relationship with Penn State's Volunteer Income Tax Assistance, also known as VITA program, and Professor Ed Jenkins serves as the faculty supervisor for the PSU VITA program. Edward Jenkins is a professor of practice in accounting at the Smeal College of Business. He holds both a bachelor's and MBA from Smeal, as well as a Master of Taxation from Villanova Law School. Ed brings extensive practical experience in taxation, accounting, and finance, with expertise in areas such as multinational taxation and mergers and acquisitions. He also leads Penn State's VITA program, which provides free tax preparation services and supports financial education and community outreach. Professor Jenkins is a member of the American Institute of Certified Public Accountants' Tax Practice and Responsibilities Committee, and he is actively involved with the Pennsylvania Institute of Certified Public Accountants. He has published widely on tax and business topics, including some recent articles on the One Big Beautiful Bill Act and Name, Image, and Likeness, or NIL, income. Ed's dedication to education and service was recognized by Penn State's 2024 Outreach Award. We truly value his collaboration with our center and his ability to make taxes feel more approachable. So with that said, I am happy to turn it over to Professor Ed Jenkins.
Well, good afternoon, folks. I hope everybody can hear me. Give me a thumbs up if you can. Am I coming through loud and clear? Yeah, that's great. Okay, awesome. I'm going to share my screen here. And thank you very much for that wonderful introduction, Melanie. I hope I can live up to all that stuff you said about me. Thank you for being so pleasant and nice about that. So let me share my screen now a little bit, and I'm going to replace the current share if that's okay with Melanie. And let's see if I can do this right. And with a little luck, you're seeing the big blue screen here, individual income tax overview. And so let's talk a little bit about what we'd like to accomplish today. So our learning objectives for today is you should be familiar with where to contact the Volunteer Income Tax Assistance Program if you should be interested in having some help with your taxes. Hopefully, we'll talk and gain you some understanding with respect to what is a dependent for filing purposes. We'll talk also a little bit about scholarship income and other sources of income you might experience as a college student. Talk a little bit about self-employment income because we have quite a few students who do occasional gig work, which is not an employee status item. It's often called self-employment income. So we'll talk about that a little bit. Talk about when returns are due and when you have to make payments. And last but not least, we'll highlight a few issues that are facing students today. So let's go ahead and take a jump into this. So VITA is an IRS program that provides free income tax filing assistance and services to taxpayers who earn less than $67,000 a year. Now that number's a little bit fuzzy, so it's not a hard and fast number, so we have a little flexibility there. Now, some returns are what we call out of scope and we can't really help. And those are the types of returns that have extensive business. So we have, believe it or not, quite a few entrepreneurs here at Penn State. And so we can't really help them too much with their returns. We also have quite a few students with some gambling income and cryptocurrency income. And those as well are a little bit out of scope for us to do. And we'll have to refer you to a tax practitioner for help with those. And cryptocurrencies include things like Bitcoin, just FYI. So we also do some educational work at VITA, helping students understand taxes. And we have a VITA page available to you that's here in the PowerPoint slide. And you can connect with us through that web page. You can also connect with us through our phone number, and that's 814-863-4147. And we're located in 216 Wagner Building. And so typically we open up appointments in the January timeframe. And then you can come in and drop off your information. We'll do your taxes. And then you can come back and review your tax return with us, make sure everything is good and meets your expectations. And then we'll have your refund direct deposited to your bank account. We do that for security purposes. Primarily. We also e-file your return, and so that's done so that we make sure the IRS gets an accurate return and there's no data entry issues when the IRS has to do a manual return. We'll talk more about the IRS in just a little bit. Now, a wonderful gentleman, Barry Rossman, is the day-to-day VITA coordinator, and that's the person that you'll likely deal with if you do use our services. I am the overall the faculty member responsible for the program, and you see how to connect with us through our emails right on this screen. So I'm ERJ2@psu.edu, and Barry is BGR2@psu. That's when you know you're old, when you only have a single digit after your initials in Penn State's email system. So most of our work is done by student volunteers. So each year in the fall, we recruit student volunteers. So if you think you might want to learn how to do taxes for others and engage and provide outreach to people who may be less fortunate than you are or need some help with a difficult tax question, please consider being a volunteer next year. So all you have to do is click on our website and connect with us in the fall. And we'll do all the training for you. We'll get you all set up to take the exams and become an IRS certified volunteer. It looks great on the resume because you're engaging with your community. Plus, you also have a marketable skill. So it's a great volunteer opportunity to consider. We have some terrific student officers this year led by Ashley Bowling. I won't go through all their contact information, but certainly you can give them a shout if you have questions about VITA, and they're terrific. They help us run through, we did last year 840 tax returns for folks here at Penn State. So I'd like to talk a little bit about filing status because it's a little bit confusing, and it's one of the key things you have to figure out when you're doing your tax return. So we have a handy chart here. how to figure out your tax your filing status for tax purposes. And it starts here in the upper left corner. Were you married? Now, the criteria is this flashpoint. As long as you were married by 11:59 p.m. on December 31st, you can be married for the entire year. So if you were married, then we go and take a look at whether or not you actually lived with your spouse. If you did live with your spouse, well, guess what? You can file married filing jointly, and there are some tax benefits to doing that. If you're not married, that's over here on this sort of flow chart. As long as your spouse didn't die, that's a special circumstance. If you pay more than half of the cost of keeping up your home and you lived in it for more than 6 months and you had a qualifying child or parent or other qualifying relative and you were unmarried, you could be the head of household. If you don't have those folks living with you, then you're going to file as a single person. Now, it's kind of a little bit tricky here because if you're a dependent of somebody else, then you're limited for your standard deduction, which we're going to talk about in just a second. So the three big filing statuses are married filing jointly, single, and head of household. Now, in some limited circumstances, married folks may choose to file separately, what we call MFS, married filing separately status. Then you lose some tax benefits when you do that, but there are some limited circumstances where it may make sense. Now, I've never actually seen, with one exception, where filing married filing separate was actually beneficial in terms of the amount of the tax liability. So usually the folks do that. For married filing separate is where somebody's not so comfortable with the activities of the other spouse, that maybe the spouse is doing some illegal things and not reporting them correctly. And so sometimes marriages aren't always what you might think they are. We have some folks decide to file separate from their spouse in order to protect themselves from their spouse's activities. So enough said about that. Just know that, hey, sometimes it's worth it to do married filing separate. So 4 categories in total: married filing joint, married filing separate, head of household, and single. Now, this issue of dependency is a bit challenging because, hey, you're in that school age folks. So if you're students, you may be in that 18 to 24 range. And so your parents may be helping you through college and supporting you. And so the question of, are you a dependent of your parents or are you independent? That's a big question because it really determines your standard deduction. So we go through this process of thinking that determines if you're dependent, first as a qualifying child, and second, if you don't meet the criteria for qualifying child, you may meet the criteria for qualifying relative. So we first start off the analysis for qualifying child by relationship. And so pretty much if you're a lineal descendant, you meet the test for relationship. So if you are a child and your parents are there, you obviously have a relationship. So you meet the relationship test. Next is the age test. And so if you are over 18 and under 24, you're going to meet the age test if you are full-time in school. So up until age 19, you're a dependent of your parents. After age 19, you're still a dependent if you're a full-time student, all the way up to when you turn 24. So if you meet the age test and the relationship test, you might be a qualified child. The next thing is the residence test. And so the residence has to be the same as the person who's claiming you as a dependent for more than 6 months of the year. And the last test is the support test. So if the person claiming a dependent is supplying more than half of the support of the dependent, then you are a dependent. So if you meet all 4 of those tests, there's a relationship, you meet the age requirements, you are residing in the same residence for 6 months of the year, and you meet the support test, then guess what? You're going to be a qualifying child. Now, if you blow one of those 4 tests and you don't qualify as a qualifying child, you may still end up being a dependent as a qualifying relative. Now, there's an expanded relationship test. So there's all sorts of aunts and uncles and grandparents and all sorts of relationships. In fact, the relationship can be as simple as the person lived as a member of your household for the entire year. It doesn't even have to be related. So the relationship test for the qualifying relative is a little bit different. The second piece of qualifying relative, of course, is the support test. So again, more than half of the support. And to be a qualifying relative, there's a cap on gross income. And that cap for 2025 is $5,200. So here's a chart that can help you walk through whether or not you're a qualifying child or a qualifying relative. This chart's from 2024, so I just need to update the gross income amount at the bottom. And so for 2025, the gross income amount is $5,200 and not $5,050. So if you'd like the step-by-step to figure out if you are a dependent, then you can use this chart to help your way through. Now, a couple important notes in using this analysis. Number one, your scholarship does not, if you have a scholarship, does not count for your support test. Second of all, your residence at school is construed to be a temporary residence. And so your time here is actually time spent at your primary residence with your parents. So your residence at school is temporary for the purposes of the residency test. Now, please note, if your parents qualify to include you as a dependent in their return, then you can't file as an independent person. And it doesn't matter if they actually claim you as a dependent or they don't claim you as a dependent. If you qualify, they are entitled to claim, but you cannot be independent. So that's an important consideration as you work your way through the logic of the qualified child or qualifying relative status. Now, if you are a dependent, then your standard deduction is limited. And that's an important consideration because for 2025, the standard deduction for a single person is $15,750 if you are independent. If you're a dependent of your parents, then your standard deduction is limited. So it's the greater of $1,350 or $400 plus your earned income. So if you have a job and you made money, it'll be $400 plus the amount of your earnings up to the $15,750 for 2025. That number increases for 2026 for your planning purposes to $16,100. So that's your standard deduction, and that's what's at risk here in dependency, if you will. Now, final word on dependency, talk to your mom and dad. So if they're planning on using you as a dependent, if you file your return first as an independent person, then when they file their return electronically, their return's going to get kicked out and say, no, sorry, somebody's already used this social security number. And you're going to have a really unhappy phone call with your parents if that's what happens. So be sure to communicate with your parents regarding your dependency for tax purposes. And if they qualify to claim you, then you cannot be independent. So I'd like to talk a little bit about the taxable income of students. Specifically, I want to address scholarship income. And so scholarships received by degree-seeking candidates are excluded from income. You don't have to put it in your tax return unless the scholarship is more than your qualified expenses. And when I say qualified expenses, I'm talking about the actual tuition plus any required fees that you're supposed to pay. Any required books, equipment, and supplies are also included in that definition of qualified expenses. So if your scholarship just covers those things, there's nothing taxable. But if your scholarship exceeds those qualified expenses, then your excess is taxable income in your tax return, and you would have to report that. And of course, you could use your standard deduction to reduce that. Now, scholarships received that pay for anything else, like room and board, that are above those qualified expenses, are going to be taxable. Now, if there's a stipend or some extra compensation included in your scholarship, again, the amount above the qualified expenses is taxable income to you. Now, if you're not a degree-seeking student, then the entire scholarship is subject to income tax. And that's for federal purposes, I think, as well as Pennsylvania. So a little bit about self-employment, because I do need to address that with students, because we have some students that engage in activities that fall under this umbrella called self-employment income. Now, self-employment income is reported generally on Schedule C, unless you're a farmer, in which case it's on Schedule F. You reduce the amounts that you have earned as a self-employed person by all allowable and necessary expenses. Oh, okay, good. Are you changing the PowerPoints there, Melanie?
Yeah, sorry, Ed. It stopped sharing on your screen. It
Oh,
wasn't showing up anymore, so I just wanted to get back on that so that we have the information there.
okay. Sorry about that. I didn't do anything on my end, I hope.
That's all right. I'm gonna make sure we're on the right one. Here we are.
There you go. Okay, so as I mentioned, you include your gross income on Schedule C, but you are allowed to deduct anything that's ordinary and necessary, any expenses that you incur to support that revenue. So if you're, say, an Uber driver and you receive X dollars of income from them, you're entitled to take a deduction for the wear and tear on your car. You can also use the standard mileage deduction against that income. Now, the net income after those expenses are subject to both income tax and self-employment tax. Now, you might not recognize self-employment tax, but it's what we pay as employees. It's what we pay as Social Security and Medicare taxes. So you have to pay into the Social Security system. So hopefully you have some benefit when you do retire at some point. Now, generally, you'll need to set aside 30 to 40% of your net self-employment income because the tax rate for self-employment tax is 15.3%. Now, you get a deduction for half of it for income tax purposes, but it's 15.3%. And then your income tax rate for federal will run anywhere from 10 to as high as 37% if you're doing really well. But probably be 10 or 12% or possibly 22%. So if you add 15.3% and say 12%, that's 27%. You'll probably have Pennsylvania state income tax at 3.07%. And you may also have local income tax at anywhere from 1 to 2%, depending upon where you live. So you add all that up, and you probably want to set aside at least 30% of your net self-employment income and put that into a savings account from which you'll make estimated payments. And those estimated payments are made 4 times a year. So I am advancing if you could advance the PowerPoint slide, that'd be terrific. Now, self-employment activities include sort of being your own boss and being an entrepreneur and owning your own business. But you also see it when folks work for others on a contract basis. So working for individuals or businesses on a contract basis as an independent contractor generates self-employment income. We also have kind of a new thing called name, image, and likeness income for student athletes. And so student athletes earn a whole bunch of different streams of income from NCAA revenue sharing to their scholarship income to name, image, and likeness income from a collective or from contracts through an agent for advertising and other promotion. Students may also have social media affiliate marketing revenue. So you may have a social media account that you get paid advertising money for. That's also self-employment income. And that's all going to be taxed not only for income tax purposes, but self-employment tax. Another group of folks that end up being self-employed are gig workers. Those are non-employee contract workers like Uber drivers, Lyft drivers, and folks like that, or delivery folks that may not be taxed as an employee by the service provider. So self-employment income is a bit expensive. You need to make sure you're putting enough away into your savings account to make all the payments that are required by law. So I'm moving down a slide. And so you may be entitled, if you are self-employed, to a special deduction called the Qualified Business Income Deduction. Now that came out of the Tax Cuts and Jobs Act, and it was just made permanent this summer by the One Big Beautiful Bill Act, or what we call OB3 or OBBBA. And guess what? You get a deduction for 20% of the self-employment income. And that's only for the determination of income tax, not the self-employment tax. And good news is, if you are self-employed, you could actually contribute to a simplified employee pension plan called a SEP IRA, and that will reduce your income tax bill if you do it as a qualified plan before tax. You could also set up a Roth IRA and contribute that up to the specified limits. So there are some special benefits for self-employed folks in addition to what's available to everybody. So I want to advance the slide and talk a little bit about when returns are due and when you have to make estimated payments. So going down one slide, the return is due this year for 2025 tax years on April 15th of 2026. Now, you are allowed to request an extension if for whatever reason you can't file your return by April 15th. Now, it's important to know you can extend it for 6 months all the way to October 15th of 2026, but you have to have the payments in. So you can extend the filing of the return, but not the payments of tax. You have to have 100% at least of your tax due paid in by April 15th. You can put off filing the form all the way to October, but you have to have 100% of the 2025 liability paid in by April 15th. Now, you can have that withheld at work if you have a job, or if you are self-employed, you have to pay in quarterly. And so you have to pay a fourth, a fourth, a fourth, and a fourth on April 15th of 2025, June 16th of 2025, September 15th of 2025, and January 15th of 2026 with respect to your 2025 liability. So those dates have already passed. So hopefully if you had to make estimated payments, they're all paid. And so you'll just make up any difference or get a refund when you file your return on April 15th. Now, in 2026, again, you have to have 100% of your tax liability paid in by April 15th of 2027, and you'll need to make quarterly estimated payments if you're self-employed on April 15th, a fourth on June 15th of 2026, a fourth on September 15th of 2026, and the last installment is due January 15th of 2027. And then, of course, you'll file your 2026 return by April 15th of 2027. So it's important to note, if you're not having it withheld at work, you need to make estimated payments, and those go in quarterly. Now, moving on to our federal tax formula, I just want to talk a little bit about how we calculate taxes. And so we take this big idea of gross income. And to give you an idea how big gross income is, the definition in Section 61 is all income from whatever source derived. So that's pretty ridiculously big. It includes generally salaries and wages, income from self-employment, interest, dividends, passive income like rentals. So there's a list of 12 things that are definitely income in Section 61. But the definition is very, very broad. Basically, if you're better off, it's gross income. Now, you are allowed some adjustments to gross income. Those are things like your contributions to your retirement plan, And then you end up, after all of those adjustments, you end up with this key metric called adjusted gross income. And that's an important number to remember because a lot of limitations and thresholds in other areas of your return are based upon adjusted gross income. So that's an important number to remember. From adjusted gross income, there are really just two deductions left. The first one being the greater of your itemized deductions, if you're allowed to itemize, or your standard deduction. And the second deduction you're allowed is the qualified business income deduction that I mentioned earlier that's available to self-employed folks. And so after you reduce your adjusted gross income by those two deductions, that's what we call our taxable income. We apply a series of graduated tax rates ranging from 10 to 37%. And so most folks are in the 12 or 22%, but our upper income folks could be in a much higher tax bracket. And as I mentioned, there are 7 of them. The Sokolov-Miller Center has a handout that VITA prepared that identifies all of those tax rates and the rates at which they apply. So I'm not sure, Melanie, how we're going to get that out to folks, but it is available to you. You can probably ask for that if you just shoot that in the Q&A problem, or perhaps you can put that up on the web page and have a link there for that. That's available for both 2025 and 2026. So we take your taxable income, we apply the tax rate, and that determines what we call your tax liability. That's how much tax you are owing for the year. Now, that's reduced by any credits, like the child tax credit that you maybe have available, or perhaps you or your parents can claim education credits, like the lifetime learning credit or the American Opportunity credit. So you reduce your liability by any credits that are due and any advanced payments through withholding or estimated payments that you might have made. And that leaves you with the net amount of tax that's due with your return or the refund to which you're entitled. And so that's a very simple idea of the general tax formula. So moving on, I'll refer you to those 2025 and 2026 tax rate schedules. The good news is they changed in the Tax Cuts and Jobs Act in 2017 to much more generous schedules, and so did the standard deduction. We eliminated the deduction for personal exemptions then. The good news is the One Big Beautiful Bill Act made those 7 higher brackets permanent. So we now live with those permanently, and we also have those higher standard deductions included in the tax law permanently as well. So check out those 2025 and 2026 tax rates if you have a moment. Those handouts also include the standard deductions that are available. Melanie, I was going to switch over to that just to do a quick nickel tour, but I guess we'll sort of pass on that. And if you can make that available for folks through your webpage or through a link or something in the Q&A, that would be terrific. So moving on, I just want to touch base. We've got a couple minutes left. Just want to touch base on top tax issues facing students today. And so if you could move the slide up one more, that would be terrific. Now I have to mention, it's not a happy place to be at the IRS today. So the IRS is not very functional. So before the recent budget cuts, the IRS had about 90 different information systems that they operate. Some of those systems were written in a language called Fortran and COBOL. Now, you probably never heard of those because they're ancient. They're 50 or 60 years old. In fact, the IRS has a hard time finding programmers who can actually maintain those systems. The Inflation Reduction Act from 2021 gave the IRS many billions of dollars to update all of those systems. Now, subsequent to that, guess what? Those dollars have been clawed back. So they started these projects to update the systems, but now they're having to give back some of the money in the current legislation. And so they haven't finished many of these updates. In addition to that, the administration has done a reduction in force or RIFs, and the IRS is now 25,000 people fewer than they were at the beginning of 2025. So the IRS is about 75% of what they were a year ago. Now, what's that mean to you? That means send in your return electronically, number one, and that way you know what's going in correctly. Number two, you should receive your refund as a direct debit or direct credit to your bank account. And if you do owe money, I would have it directly debited from your bank account. Now, the reason for that is the IRS is expected to have some challenges, especially when it comes to managing and processing paper or manual types of submissions. So do everything electronically that you can. Additionally, do it correctly. So don't try and scam the IRS or hack the system. Just remember, it's very expensive. And the way it works, if something mismatches in your return or is not calculated correctly, you'll receive what's called a 30-day letter. As the name suggests, the IRS gives you 30 days to respond. If you don't respond, or you do respond and the IRS doesn't process your response within the 30 to 45 days after that 30-day letter is issued, then you're issued a 90-day letter. Now that might not sound too intimidating. You've got 90 days to respond to it, but it's also known as a statutory notice of deficiency. There are two responses to a statutory notice of deficiency, and those involve either paying what the IRS has assessed or suing them, going to court. Going to court is expensive. So anytime you end up in court, remember, America has the best legal system money can buy. Anytime you've got to go to court, you lose because you've got to pay somebody to represent you. And that'll be anywhere from $200 to $1,200 an hour. So it can get very expensive if you run afoul of the IRS and you have to pay for representation. So it's exceedingly expensive. So the takeaway is keep your business clean, file your return correctly, and don't try and hack or scam the government. And that means if you're self-employed, you got to include it in your return. We could go down one more. I have to talk about the OB3, the One Big Beautiful Bill Act that was passed this summer. So it made a lot of changes to the Internal Revenue Code. It's a lengthy read, so it's a very, very big bill. Now, we have been keeping the government open. And so just to give you a quick idea of how the government stays open, the federal government's budget year is October 1st to September 30th. And they're supposed to have a budget in place. And the way the budget works, once Congress passes a budget, that gives the administration the authority to spend the money. And so you have to have a budget to spend the money. Otherwise, the administration is not allowed to spend money. So we haven't had a budget passed in most of the last 20 years or so. I think we had a budget on time once. So we continue to keep our doors open by what's called a continuing resolution. And so to actually have a budget, there are 12 appropriations bills that Congress has to pass. Now, they've managed to pass a few of those. I think they have 6 passed. They have 6 left to get done. And they are open right now. We had a shutdown for 30 some days in September, and that put the IRS way behind in terms of getting ready for this tax season. Now, the continuing resolution they passed to reopen the government in October expires January 31st or 30th, excuse me. And so guess what? There's a decent likelihood if Congress doesn't pass those remaining appropriations bills that they're either going to have to do another continuing resolution or we're looking at another shutdown, which will be a disaster for the IRS to shut down essentially on opening day. Opening day is January 26th for the IRS. If we shut down on January 31st, that'll be highly problematic. Now, if you electronically file your return and you get a direct credit for your refund, those will all probably still be processed, even if there is a shutdown. But in any event, it's going to create nightmares for many departments of the government if they have to shut down. Now, a couple other important things from the One Big Beautiful Bill Act. Form 1099-K deals with the reporting of payments made. And so for 2025, that was supposed to drop to $600. And so that can get really confusing because if you're using PayPal or Venmo to even just, settle up with roommates for a shared rent or something like that, that could have gotten caught up in the reporting. Now, the OBBBA essentially changed that reporting threshold, and we're going to keep it at the old threshold of $20,000 in receipts or 200 transactions a year. So you're not going to have to worry about 1099-K reporting pulling you into self-employment reporting for stuff that shouldn't be self-employment income. Now, remember that whether or not you get a 1099 is not relevant. If you received income, it's got to go in the return. So even if you didn't get a 1099 for whatever reason, you still have to include it in your return. Now, we also have a new form called Form 1099-DA. That's for digital assets. And for 2025, Form 1099-DA is required to be issued by the folks that manage the exchanges for gross proceeds received. That means you've got to figure out what your basis or what you paid for that cryptocurrency is in order to report the proceeds and reduce it by your basis so you don't pay tax on the gross proceeds. Now, the IRS considers crypto assets to be property for tax purposes. That's just like stocks or bonds. So anytime you dispose of cryptocurrency, and that's even if you're using Bitcoin to buy some aspirin at CVS, that's a gain or loss transaction that has to be reported. And so Form 1099-DA will report the gross proceeds in 2025. It's your responsibility to make sure that gets onto your Schedule D as a capital gain or loss transaction on a timely basis in your return. In 2026, the exchanges are going to be required to report not only gross proceeds, but also your cost basis, so you can figure out your return a little bit easier. I'm getting a little close on time, so I love talking about taxation and generative AI and agentic AI. So please note that artificial intelligence is changing our tax world in a hurry. The IRS is using AI to figure out who to audit. Tax preparers and taxpayers are using generative AI to figure out their tax returns and tax return positions. Please, it's important to note that AI tools are not fault-free. So you have to make sure that your answer is correct and be informed enough to know when the generative AI tool like ChatGPT or Copilot is giving you a correct answer. So just please remember to check with a professional or check with other research software. As a Penn State student, you have access to wonderful tax research tools in Bloomberg Law, CCH Vital Law, Tax Notes Today, and RIA Checkpoint. So 4 great resources to make sure your generative AI is giving you a good answer. So I just want to advance a screen there. Okay, super. So I would like to give a shout out to Sokolov-Miller and encourage folks to have a budget. And budgeting is important so you know how much your means are so you can live within your means. And so I would encourage you to connect with Sokolov-Miller to have a budget and don't blow your money without planning or thinking things through. You could end up going hungry at the end of the month or end of the semester if you haven't planned your money well. So please, please, please visit the Sokolov-Miller folks and make sure you're budgeting and doing your job there to make sure you don't run out of money. If you can move forward to the next one, if you are self-employed and you're wondering about whether or not you need an LLC or a corporation or some kind of business entity for your activities, you should consult with legal counsel and get your entity set up working through an attorney. If you are doing those kinds of activities, you also should consult with an insurance advisor regarding the necessity for liability, property, casualty, or malpractice insurance for your self-employment activities. For sure, make sure that if you're doing something like Uber or Lyft, make sure that your auto insurance policy covers you for business activities. You could get an unhappy surprise if you have an accident and you say, oh, gee, I was just doing Uber driving, and your insurance company says not covered. So please, please, please make sure your insurance is covering those activities. If your income is under 67,000, we're happy to help you do your return. So you can set up an appointment through our link here to the VITA program and schedule an appointment, and you'll be greeted by a greeter who will accept your information and review it with you. Our volunteers will process your return and then give you a shout back when it's time to pick up your return, and they'll review it with you, and then we'll electronically file it for you, and you can have your refund directly deposited into your bank account. Other rules apply if you're a non-US person. So there's a whole bunch of treaties and exceptions, and our folks in VITA can help you work through those if you're not a US citizen or resident.
Ed, thank you so very much. If anyone does want access to this recording, you can check out our YouTube page, and you can see not only today's recording, but also recordings from previous webinar series from different semesters that you're welcome to access at any point in time. Yeah, if anyone has any questions or anything else beyond the webinar today, as you're thinking about taxes and things come up, please, please, please reach out to PSU VITA. And of course, we here at the Sokolov-Miller Family Financial and Life Skills Center can help you get headed in the right direction if you feel stuck. Thank you for spending an hour with us today, and hopefully we will see you back again on Tuesday, February 3rd at noon for Building a Better Budget.
Thank you all for taking some time to spend with me today. I sure appreciate it. And feel free to give us a shout at VITA if you do have questions or need some help with your return.